Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO Founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Roger Nanney, Vice Chairman of Deloitte LLP and the National Managing Leader of Deloitte Growth Enterprise Services, about the results of their recent survey of middle market C-level executives, which shows a tapping of the brakes in terms of C-suite expectations.
Interesting report this time. Quite a bit more downbeat than prior quarters or prior reports. Seems to be a little bit of a pullback.
Well, Paul, it's the fifth year of our survey, so we've now been watching coming out of the downturn. This survey has continued. The trend has been sort of affirming confidence and these executives responding in a positive way around investments and growth opportunities. And this is the first time we've seen, as you said, a little moderation in their expectations about the economy and their views about their growth going forward. But I do think it's important to put it in context. It's not, it's not a hard stop. It's not, no growth. In fact, I'll give you some stats a little later that would, I think show, pretty good confidence and pretty good prospects going forward, just not what we've seen in the past. And that's why we say in this report, we talk about the responses being sort of like tapping the brakes,
right,
as opposed to, a hard stop. And I do think that's an important point to keep in mind as you read through the results.
Sure. And I'm pretty sure, I'm absolutely certain, actually, that the results of the survey were received and compiled prior to sort of the turmoil in China. I mean, and the turmoil in China has been sort of growing, so it's not completely a surprise. But obviously, recently, it's really hit hard, certainly in the China marketplace, but also in terms of their growth projections. And I guess I'm wondering, the pullback, as you say, it's tapping the brakes. It's not sort of doom and gloom, but let's say the somewhat moderated expectations that we see in the report, are they due to primarily, you think, to domestic concerns and domestic demand, or is China and a fair amount of the rest of the world in terms of the emerging markets, that slowdown having a dampening of expectations as well? Because at least as I recall, and you would know this better than I would, but at least as I recall, the U.S. middle market, its exposure to those markets are not insignificant, but they're not overwhelming either. So I'm just wondering what your take is, and obviously that's probably changed since you got the results. But I'm wondering if this moderation of expectations is due largely to domestic things or to kind of the fear of a global slowdown.
Mm-hmm. Well, I do think the China situation is a good example of what helps to create uncertainty, an uncertainty around the economic environment for these executives. But you're right. These executives, 92% of these businesses expect the majority of their growth to come from the great majority of their growth to come from the U.S. market. We've asked the question before, and I think about 70% of these businesses have some element of international revenue as part of their business, but it's essentially a U.S.-based focus when it comes to revenues and growth.
Right.
But as well, you're also right, Paul. The survey was conducted last week of October, the first week of November, and so that was in advance of the interest rate increase as well as what we're seeing, internationally. But all of those, events I think, are really good examples of, the perception of these executives and business owners about, the types of things that create an uncertain economic environment, and therefore then cause them to sort of moderate their expectations.
Right. Right. And it's perhaps this is compounding that sense of uncertainty. But as your report noted at some length, actually, we're obviously heading into an election year, what could be a fairly consequential election year, and that seemed to come out in the survey. It struck me as interesting that the healthcare costs and the ACA or Obamacare or whatever you want to call it has now sort of jumped to the fore here a little bit after as a concern for middle market companies, as an obstacle to growth and an obstacle to the U.S. economy. I thought that was very, very interesting because it had been somewhat tempered as time had gone on in your previous reports. Which actually also surprised me, but I guess I think it was mentioned. Sometimes you don't recognize it until it's upon you. And of course, there's the perennial taxes are too high, corporate taxes are too high, the regulation issues, interest rates now, which of course becomes even more important. I just think it's interesting that. Well, maybe it's not interesting. Maybe it's entirely predictable. But the uncertainty, of course, with respect to the presidential outcome, seems to have an impact on their perspective on growth as well. Is that? Am I right on that?
Well, I think you point out, a really important consideration for the next leader in the U.S. We don't know how the political situation is going to play out, but certainly as you read the concerns of these executives, after an uncertain economic outlook, which is number one on their agenda, you do see healthcare costs spiking up. That's moved, up on the agenda. And I think you're right. What's happening, it looks like, is that, we're just now, in implementation this last year around the employer mandate. You've got now this Cadillac tax, the potential of a Cadillac tax, being imposed on these businesses that have certain high-cost health plans. So it is, as you say, it's now sort of right in front of them. And as well, you've got continuing increases in healthcare cost, new treatments and just general increases that they now see, in their expense line. And that then, forces these executives again to sort of have to consider how they manage through that, and that's up on the list. Regulatory, comes in at third when they look at obstacles to their own company's growth, and we see that not only in healthcare, but we've had the environmental regulations come out with the energy sector, and the regulatory environment is one that has been a concern, but it's obviously moved up in terms of importance. One thing you didn't mention, which was insightful to me because it hits on 2 points that, are issues generally, and that is this, what I'm going to call a little bit of a technology budget crunch.
Yeah.
Because they, down just past increasing interest rate concerns is a concern on these executives' part around keeping up with technology change. And therefore, we see them sort of backing off some in terms of planned investments. And I think that's a twofold issue. One is again, the opportunities that come with the democratization of technology, cloud, analytics, and mobile and the like, which now allows middle market businesses to be on a level playing field with their larger corporate counterparts. But on the other hand, I think they're dealing with talent challenges, the right people to fill the jobs to do these kinds of important technology implementations and to maintain these systems, just like we see talent challenges across other parts of the business.
One of the things you didn't mention in there was Internet of Things. which is, it clearly didn't come up here, and it may be a little bit early for this to be a major concern. But boy, that technological pace of change is not slowing down anytime soon. And so your point is really quite interesting. Do you think it's kind of I understand the talent side too, which actually I was going to talk about in a bit, but do you think that this is just a breather where middle market companies are kind of going, okay, we've implemented a whole mess of new technologies. Let's get those sorted out and productive. Then we'll move on to the other things, because you've got as your report points out, there's four of them. Sort of the cloud computing. It's not new, but it's still in its first wave, I would guess. A way of putting it. Data analytics is also a relatively new thing that is being sorted out. And then you've got automation of business processes. That doesn't even get to Internet of Things, which is probably the next wave. So I guess my question is to you: Do you feel like this is kind of a let's take a breather and deal with the stuff that we've invested in, because there's been a lot of investment in technology recently, and then we'll move on and start investing again? What do you think?
I do think that is one of the potential reasons why we see these executives reporting that they're pulling back a bit in terms of implementation of new systems, as well, and maybe even more so. It's given what you just said around what we've seen the last couple of years. It could be they've made their investments and they're simply in implementation. Yeah. And therefore you don't see the spend. And a little bit of support of that would be, further down in investment priorities, you've got almost a 5-point increase in the area of technology, just simply upgrading existing systems. Right. So, I think to your point, I don't think the investment. There's still investments, their percentages in terms of numbers around investing in new systems is pretty healthy. But I do think there's now an issue of sort of how do we make sure we're, taking advantage of the right opportunities and learning these systems in a way that they can get the sort of productivity and efficiencies that they were hoping for.
The talent part of the technology side is also, I think, interesting to me, and yeah. It actually sort of raises a broader question in my mind with respect to the middle market. As you pointed out, the report points out, as many folks have pointed out, there's this talent gap or skills gap. There's just there don't seem to be enough qualified folks for the jobs, which in and of itself is confusing to me, given the fact that the labor participation rate in the U.S. is the lowest it's been since the late 70s. And, we do have pretty decent immigration amount of quota for the H-2, whatever those visas are for STEM folks. And yet, and we also have relatively stagnant wages. Now, I realize the wage information is a pretty broad stroke, but I'm pretty sure that the STEM side is not. Their wages aren't going up dramatically either. There just seems to be this huge dichotomy to me that we there doesn't seem to be enough skills, people with the right skills in STEM stuff. Obviously, technology being one of them, and yet wages aren't rising very quickly. What in the middle market? What do you see in terms of that? Is the middle market wage situation different than what the general economic sort of the general economy issues are, or no?
Well, you hit a very good point when it comes to the talent area. Let me just maybe speak to a few things that I think sort of answer your question. First of all, in the talent area, that's the one place in the survey where these executives aren't backing away. So it's a top investment choice, and it continues. There's we didn't see any moderation there.
Right.
And the way they're investing is the number one place they're investing is in training. So what's happening is, and we've seen this evolution over the last few surveys, because you've got this skills gap. We had 56% of these executives say they increased their headcount in the last 12 months. 61% say they're going to be increasing in the next 12 months. But 2/3 say they can't find the people with the skills to fill the positions that they have. So hence you see these companies building their own training platforms, and they're hiring people and bringing them into these companies, which is a great opportunity because these companies are often really nice spots for people to grow a career because they have better access to senior executives. It's a flatter organization structure. They can be autonomous. There are a lot of benefits there, but essentially they're going to have to train these people, and maybe that draws or gives some energy to increasing the labor participation rate. Maybe we will eventually see that number go up as these companies keep investing on hiring and training. The other interesting element here is, as you mentioned, compensation. We did see this time number 3 on their list of investments is to increase compensation. So they're making investments in training, they're hiring people, and they're also going to be increasing comp. So now that we're 5% unemployment, we're adding I think almost 300,000 jobs in December. I think now you're going to start to see wages start to go up in these companies.
In touching on the wage thing again, and then the other elements, I noticed there was a declining expectation, still not doom and gloom, as you said, but a somewhat of a pullback in expectations for profitability. And one of the things that I'm struggling with looking at, the overall picture for the middle market, and it obviously depends on the sector, the industry, but I look at sort of the macro elements that are there, and even with as the survey points out, there's not a lot of pricing power right now. Where not many folks are able to raise prices, or at least if they do, not by very much. And I understand that, but even with that, I'm looking at the pretty much wage stagnation. So personnel costs really aren't going up that much, if at all. Energy and commodity prices are collapsing, which obviously does harm to like I said, to a certain sector. Obviously, the energy sector and all that entails. But it just strikes me that inputs are, and I guess I'm really thinking more manufacturing. Inputs are really either staying flat or decreasing. I mean, the producer price index went down again this month. It just surprises me that people would be so negative on profitability. And of course, we have interest rates that, while they just got bumped up a touch, it doesn't look like they're going to be going up that much over the next 6 months. Is there something there in the profitability side that I'm missing that makes them a little bit less confident about profitability?
Yeah, it's a good question, and Paul, I'm not sure I have a good answer other than, where we see, the investment increases. I mean, it's all about trying to get productivity and efficiency, and they are spending on technology. We've seen, higher investment rates in capital equipment and all the whole area of CapEx, which it moderated a bit back in this last survey, but it's been increasing. And I think what's happening is we're seeing these transformations, and buyers are continuing to put pressure on I need to keep my prices in line with what the market demands, and therefore, I'm going to have to ask you to continue to put pressure and get the kind of efficiencies and productivity that allow you to make your profits at a stable price level. But it will definitely be interesting to watch this over the next 12 to 24 months to see, especially as you start to see higher wages, whether you're going to get some pricing power back.
Yeah, right. And I have a hard time believing the commodity prices are going to remain. I mean, I've read all the scary proclamations about oil, certainly, and various other commodities, but I don't know. I have a hard time believing that's going to stay, but I guess you're right. It'll be interesting to watch. Real quickly, one more thing on M&A. That also has been pulled back a little bit. It sounds to me that it's been, at least based on what your report says, the M&A activity seems to be, or the expectations seem to be tempered a little bit in the coming year. And it sounds to me like that's just a valuation gap from what I read. It's not really a sort of fundamentals issue. It's a valuation thing, right?
I believe the report points to the fact that it's more difficult to find attractive targets given the valuation levels that we've reached. We just at the end of 2015 broke another record in terms of total transaction value globally in the M&A arena, and these businesses continue to view M&A as an opportunity, but what we saw was in terms of their top growth priority, M&A fell from I think 12% to 8%. And my view and what the indications are is that it's not a lack of desire; it's more a lack of an ability to get an attractive situation in order to feel good about it being added incremental to growth at the right price. Right. Now, maybe what that means is we see, this being the time where, people want to begin to start to get more aggressive, and you might see some pricing changes come through. But I think 2016 will be a year where we might actually see the peak coming off, or come off the peak, and hopefully we get, more volume there. The counsel from that is you just have to be a lot more diligent. You need to be, focused on evaluating these, opportunities in a way that you really understand what's underneath the hood.
Be sure to check back for future episodes of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.